There's no better way to learn the exact ins and outs of swing trading with a real world edge than by learning from a seasoned proprietary trader. And in this video, SMB seasoned proprietary trader Ryan Hassan shares all of his swing trading secrets for both beginners and developing traders. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005 and proud to develop numerous 7 and even 8-figure per year traders. Watch, take notes, and learn from a professional trader on our proprietary trading desk so you can grow your trading account.
Traders, let's not waste any time. Let me tell you exactly why my ultimate swing trading guide might help you in your efforts to reach the elusive status as a consistently profitable trader. And the simple answer is the source. I'm a senior professional trader at SMB Capital, one of the world's most successful proprietary trading firms. And everything we do here is rigorously tested. It's put to the test day in and day out by some of the world's most successful traders. So you can be sure that what I share with you today is tried and tested. And in this course, I'm also going to be guiding you step by step, teaching you exactly what swing trading is, how to precisely identify the top swing trading setups, how to manage those positions like the pros do, and how to limit your risk like an elite trader. I'm also going to be teaching you the ins and outs of my 3 favorite swing trading setups so that by the end of it, you'll have a solid foundation and be equipped with actionable insights and techniques to hit the ground running. So let's jump right into it. Now, right before we get into the juicy stuff, a little bit about the specific style of trading that I'm going to be teaching you today, and also a little bit about my background and my style. So first of all, I'm a discretionary trader. So what does that mean? That means that I'm process driven. I'm a systematic trader. However, at the end of the day, I'm a discretionary trader because I make subjective decisions about when to enter and exit, and I rely heavily on my own technical analysis to make informed decisions. Now, while I use technology to complement and improve my trading, my strategies are not automated, okay? Multiple time frames. So I trade across multiple time frames, and I'll show you exactly what I mean later in the video. So I'm an active trader intraday with several intraday strategies and across multiple days with my swing trading playbook. Over the years, my playbook has expanded along with my skill set and my time frame. I'm open-minded and I'm unbiased. All right, so I like to go long, I like to go short, I like trading small caps, mid caps, low floats, large caps, indexes, ETFs. And now, while I do like to form a bias about directional moves for stocks, once I have confirmation, my mission as a trader is to react to the price action once my plan is confirmed and ensure that I have positive expectancy and favorable risk reward and a diverse set of swing strategies. So I have several top swing strategies. For example, consolidation breakouts, breakdowns, mean reversion shorts, lower high short swings, dead cat bounce, backside shorts. And I'll go over an example for each strategy later on in the presentation. But let's cover the basics. So what is swing trading? Just before we get into the exciting stuff and I reveal my top swing trading strategies with you, let's cover the basics and build a solid foundation. All right, starting at the very beginning, what is swing trading? So swing trading, as I view it, it's a unique blend of fundamental analysis, price action trading, technical analysis. It involves holding positions for a minimum of a full day and even up to a month, 3 weeks to a month. Now, traders aim to capture a directional move, either long or short. That's the goal, by using technical analysis and price action confirmation to enter. And you can either hold for days or weeks, and then obviously you want to exit, hopefully for a gain. Now, this style sits just above day trading with regards to its expected hold time and time frame. And successful swing trading heavily depends on correct stock selection, that's vital, technical analysis, relying on price channels, volume, and several key indicators that will allow you to make informed decisions. And becoming a professional at swing trading, it's all about nailing that balance between understanding the market, picking the right stocks, effectively being able to manage your risk, and achieving a skewed, a positive risk reward. And of course, something that's vital as well is having precise entries and exits and knowing exactly what to look for when entering and how to correctly set your targets in order to exit efficiently. So, with that now being said, where does swing trading actually fit into the world of trading? And when is it best suited to be a swing trader? Well, now that you know what swing trading is and you have a basic familiarity with swing trading, who is best suited to be a swing trader and what makes a good swing trader? Well, it all comes down to, first of all, what's your individual preference? Who are you as a trader? So the suitability of being a swing trader depends on your individual preferences and your skill sets, but also things like your risk tolerance, all right? Things like time commitment, and your overall trading style. Some traders prefer the more active involvement and quicker styles of trading. Might that be momentum or scalping, for example, while others might find more extended holding periods more suitable. So there's no right or wrong, and no strategy is superior. It really just comes down to who you are as a trader and your individual preference. Swing trading can definitely appeal to those who want a balance, I would say, between active trading, but without needing to monitor the markets constantly or be glued to the level 2 or the tape, or watch price action tick for tick. Now, it relies heavily on technical analysis. Swing trading definitely relies severely on technical analysis. For those that are beginners, you might be wondering, what exactly is technical analysis? Well, simply put, technical analysis it's a method for examining, understanding, and predicting price movements using charts, indicators, market statistics. And to take it one step further specifically, I would say it's using indicators, identifying specific chart patterns, right? Using support and resistance, and identifying potential entry and exit points. So my personal favorite indicators that I use are VWAP and the simple moving averages. So VWAP, volume weighted average price, that shows me the average price based on price and volume. So it's my most important indicator, and I use it mostly to gauge sentiment intraday or over multiple days, trends, and also as a indicator for entries and exits. Now, simple moving averages, I use SMAs on my daily charts, and they represent a stock's average closing price over a specified period of time. And I find huge value, immense value in them as a trend indicator. And don't worry, I'm going to show you exactly how I set up my charts, how I use these indicators in the next section of the video. And then this style of trading, I would say, primarily works well during trending markets and periods of volatility, periods of heightened volatility. So swing trading works well when markets exhibit and show clear trends, whether that's upward, it's bullish, or if it's downward, bearish. Swing traders then can capitalize on these directional movements. And then with regards to volatility and heightened volatility in the market, that can provide opportunities for swing traders because extreme price fluctuations, that can obviously result in excellent mean reversion swing opportunities in either direction. So what time frames do I look at? How do time frames fit into the world of swing trading, and how specifically do I set up my charts? Well, I keep it very simple regarding my chart setup and my inputs, and you might be wondering, why is that? Well, purposefully, I only use the indicators that add the most value to my trading system and that make the most sense to me without complicating, without overwhelming my system, all right? Because if I consult too many indicators, or if I add too many inputs onto my screens, onto my charts, it might and most likely will actually have the opposite effect that one might think. I found early on that doing so would cause too much hesitation in my trading, and it wouldn't really add value to me. It would overwhelm my decision making. So what do I look at the most across my screens? So keep it simple, I look at volume and price. Specifically, I look at the VWAP, volume weighted average price intraday, and across multiple time frames if the stock is in play across multiple days. And on my daily chart, I look at simple moving averages. So regardless of my view on them, simple moving averages, because they're so popular, because everyone is looking at them, everyone's consulting them, I find that there's real weight behind consulting them and having them on my charts. And so what time frames am I using along with those indicators? So I'll always have at least 3 time frames, 3 charts for any stock that I'm watching. Specifically the daily chart, for me it all starts on the daily chart, then down to the hourly chart, and then usually down to the 5-minute chart. When I'm trading intraday, I'll look at the 1-minute chart, but for swing trading, it all starts in the daily chart, then I take it down to the hourly chart, and then I take it down to the 5-minute or the 15-minute chart. Now, depending on the strategy, my ideas mainly will stem, as I mentioned, from the daily chart. That's where it all starts. The daily chart with the 5, 20, 50, 200-day simple moving average overlaid. And that's the starting point for me when I'm analyzing a stock or a sector and determining whether or not there's a swing opportunity there. From there, very importantly, I want multiple time frames to align, starting from the daily, working down to the hourly chart. So the next step for me is then to consult the hourly chart to determine if there are any critical levels of support or resistance that I cannot as quickly identify on the daily chart, or if there are levels on the daily chart of support, resistance, potential inflection areas that then shine through as well onto the hourly chart. All right, along with identifying very important pivot spots, higher lows, lower highs, etc. Then the lower time frame, that's going to be used like the 5-minute or 15-minute chart when I'm actively watching the stock trade and I'm stalking it for an entry or potentially even an exit intraday. Although mainly during the morning before higher time frames have set up, that's usually when I'm always consulting a lower time frame. Once the morning trading has settled around 10:30, 11 a.m., that's when I'll primarily be focused on the 15-minute and upwards in terms of time frame, and I won't be looking or consulting anything under the 5-minute chart. All right, so let's look at an example of how all of this aligns and actually look at a real life example. So a brief walkthrough, I would say. Let's do a brief walkthrough of using multiple time frames from the daily all the way down to the 5-minute chart. So starting with the daily chart in the video, this was an actual trade plan, an actual idea I shared in my weekly watch list. And I think it's first of all important to remember that I use multiple time frames to paint an overall picture of the idea and key indicators to complement that idea and really just to facilitate my decision making. So on the daily, as I pointed out from my watch list in real time when I first shared the idea, before the breakout, I liked the multi-month consolidation in NVIDIA. I liked the multi-month consolidation, and importantly, it was above key moving averages. Okay, it was coiled near a very significant breakout area that was 500, which acted as resistance over multiple months. So the idea came from the daily chart. All right, now from the daily chart, having identified an upward trend, one of the hottest stocks in the markets, tight consolidation, a very clear level to risk against, and a clear inflection area. From there, we take it to the next time frame, which is the hourly chart, and we ask ourselves, does that level shine through on the hourly chart? Are there other areas that we would like to take note of? Well, 500, as we can see, clearly does shine through onto the hourly chart. It aligns across multiple time frames. All right. So from there, then we want to take it one step lower. All right, and we want to consult the 5-minute chart. And on the 5-minute chart, a lower time frame, and again, one that I'm going to use just for precise entries. Specifically, I'm looking for the stock to have sustained buying over the key level and to be able to hold above it. So like I said, I'll use a lower time frame when I'm stalking it for an entry. And if one isn't really focused on reading the tape, a helpful tip is to look for, you want to see sustained abnormal volume and the price to remain above the breakout level and or the intraday volume weighted average price. That could signal, very strong price action to you. And that could also signal, of course, buyers that are stepping up above the breakout level and supporting the stock. And so obviously we see that here with abnormal volume, price breaks above the key level across multiple time frames, the breakout level inflection area of 500, and it holds above that along with the intraday VWAP. So once I've entered the position using that lower time frame for precise entries, like the 5-minute, for example, I'll then have my hard stop in place. And as that trade develops, I'll switch to a higher time frame to manage the position and just to keep tabs on it. But the key here and the big takeaway here is that all of the time frames should be aligned and all of the time frames need to complement and work together. All right, but what about a template for a swing trade, and key variables and characteristics of a swing trade. So right before we go over specific swing trading setups and strategies, I want to go over the key variables and the key nuances, I would say, that make up a good swing trading opportunity. Because now that you understand, or now that you should understand what swing trading really is all about, the timeframes I use, the indicators that I consult, I want to go over the boxes that need to be ticked in order to qualify a potential swing trading opportunity. So before I look to take a trade, when I'm actually running through my charts on the weekend and I'm trying to identify new swing opportunities for the upcoming week, what am I looking at? What characteristics and what variables do I want to be present on a chart to then qualify for a potential A+ swing opportunity? And then right after this, once this is all familiar and makes sense to you, that's when we'll jump into specific swing trading setups. So first of all, the first thing that I look at, the most important and easy to understand, is clear support and resistance. So an established level of support and resistance. So I need to be able to clearly identify, looking at the chart, clear levels of support and resistance, which, if breached, could signal and confirm a significant breakout that might lead to, I would say, substantial directional moves. So what is a clear level of support or resistance? If you're not familiar, it's a price area, because it's not always an exact level or price. It's a price area. It's a zone that's been tested over multiple days or weeks or even months, like we just saw in the video, around 500, in terms of that being a significant area of resistance, making it a substantial area of interest. And it could be a breakout point, an inflection point, a significant momentum shift or trend shift for the stock. All right, the rubber band effect. So the rubber band effect, it's contraction in price and volume, all right, anticipating then an expansion. So if you actually think of a rubber band, the harder you pull the rubber band on both ends, the greater it contracts until both bands converge, until it finally snaps and explodes. All right, so for consolidation breakout, the most popular swing trading strategy, I would say, the longer the consolidation and contraction, the greater momentum might be once price finally breaks through either support or resistance, because so much energy has been built up that you're going to see a huge momentum explosion potentially once the stock picks a direction and breaches that critical level of support or resistance. So that's a nice way of visualizing it and thinking about it. All right, then you want a clear level to risk against. All right, an area of where am I wrong? If I take this trade, and you want to make sure that it has the potential for skewed risk reward. For example, if we go back to what we just walked through in the video, there was a very clear level of where one would be wrong once the stock broke out above 500, and that area would be 500, because if it got back below 500, then it would be a false breakout, and from a failed move higher might come a fast move lower. So you always want to have a very clear area of where you are wrong, and that depends on how you might define that. But that is how I think about it and define it. Notable relative strength or weakness. So I like to look for very clear and notable relative strength or weakness. For example, there might be relative strength or weakness, a stock relative to its sector, relative to the overall market, or relative to key competitors. And then I like to identify that, because that might hold well on a breakout if a stock is showing relative strength to the overall market. If the overall market is weak and a stock is continuing to consolidate near resistance in an uptrend, one might assume that once the market does bounce, once the overall sector bounces, that stock, which has displayed so much relative strength, might finally break through and continue to outperform, for example. Then the alignment of multiple timeframes, which now you're familiar with. Like I went over in the video, I like to look for numerous timeframes to align. It just gives me more confidence in the overall setup, and it always begins with a higher time frame. And I get excited when multiple timeframes align and key levels shine through and hold weight across all the timeframes. And then a catalyst. So a catalyst could be breaking news. It could be fundamentally changing, or even technical in terms of a significant shift in momentum or breakout. All right, the catalyst could be a very clear breakout level after a multiple month consolidation. Trend identification. So trend identification, like I briefly mentioned earlier, That's the key simple moving averages, and I like them to align as well with the anticipated trend of that breakout, the directional move of that breakout. What I mean is if I'm looking for a breakout to the upside, I would like to see some of the key simple moving averages obviously rising and just identifying that the stock overall has upward momentum. But for a mean reversion, for example, medium to small cap that's gone parabolic, overall several days or weeks or even months, I like to look for price then to extend very greatly from those key simple moving averages. For example, just last week, we had an exceptional mean reversion opportunity in SMCI, super microcomputer, that obviously had an RSI close to 99, and it extended greatly from its key moving averages, offering a great mean reversion trade. And then elevated RVOL. So first of all, for those of you that might not know, what is RVOL? So it's an indicator that tells us essentially how the current trading volume in the stock, all right, intraday, how that matches up to the previous trading volume over a given period of time. So I like to look for heightened RVOL. At a minimum, I like to look for 1.5 RVOL on the day of the stock breaks out above the breakout level. Um, you know, Many stocks do break out or break down without any elevated RVOL. Those do have success and follow through. Comes down to personal preference. I like to avoid those. I just like to participate in stocks with elevated RVOL. For me, it's because elevated RVOL on stocks that are breaking out, not only is there increased liquidity, it allows me to manage my risk better, more efficiently, but it also, for me, and what I've found, it signals that breakout could experience greater momentum due to the increased flow and due to the increased attention. And then lastly, it's also skewed risk reward. I like to look for setups that, if confirmed for price action, that they hold the potential and they offer an outsized risk reward. All right. I don't want to be in anything that offers a one-to-one risk reward. So I want to make sure that there's a skewed risk reward opportunity within that setup that I've identified. And for that to be the case, kind of as a benchmark, I like to really target a 3-to-1. All right. Risk one to make three, for example. That's essentially the benchmark, and that's the baseline that I like to look for. So basically, these are the fundamental boxes that need to be ticked for a swing setup to really qualify itself as a great opportunity and one that I might realistically plan for and then take. So now that you're familiar with all of that, and we've really, I think, now set a great foundation for swing trading, let's take all of these factors and let's actually look at them on a chart and then see how it all matches up and aligns. So let's look through Microsoft and on the daily chart, and let's become familiar with some of the factors that I just outlined. So again, this was another actual swing long setup. This is one that I wrote about on my weekly watch list over multiple weeks, and this is one that I actually traded. First of all, starting with the basics, support and resistance, let's look at how those were identified and how they also shone through pretty well. So you have key resistance in the 376 area of your key level of support, 365, and you have a very tight consolidation, all right? And that basically also gives you the rubber band effect. So it also displayed relative strength to the overall market, all right? That's fantastic because should the overall market start to uptick, should its sector start to rebound, Microsoft, one could expect to continue to display relative strength and break out of this consolidation. So that aligned pretty well. Then, is the stock consolidating or trending higher above key moving averages? Yes, it is. It's holding above its key simple moving averages, notably the 200-day simple moving averages, and then we can go lower into the 50-day, the 20-day, and consolidating right near the 5-day rising simple moving average. Then the breakout day. Was there volume? Was there an uptick in volume? Was there elevated RVOL? We can see here that there was an uptick in volume relative to the previous couple of weeks. So there was elevated volume and RVOL, which is fantastic. And then the length of the consolidation, very importantly for me, that allowed enough energy to build up. Again, back to the rubber band effect. It allowed enough energy to build up and displaying notable relative strength, which for me increased the likelihood of significant follow through in a substantial directional move. All right, and then lastly, the tight range here. The tight range also allowed for fantastic risk reward, long opportunity, because once the stock breaks out and holds above this breakout level, displaying an uptick in volume, you have a very clear level and area in which you are wrong, which would be the low of the day, because you don't want the stock to then fail this breakout after breaking above resistance, holding above resistance, an uptick in volume, displaying notable strength, breaking out of a multi-week consolidation. You don't want it to then take out that low and get back into the range. That would then signal a false breakout once again. So it had all of those factors and boxes checked. All right, traders, now onto what I'm sure many of you are most excited about. Let's go over 3 of my favorite swing trading setups. So starting with the consolidation breakout swing setup. So this is really a textbook swing setup, and perhaps it's the easiest to identify. So what's also great about this setup is that it can be applied for both sides. It can be applied long or short, and it also comes in handy as a result in both a bull and a bear market. And this is a setup that I've traded for many years now in individual stocks, long and short, ranging from small caps along to large caps with sector theme plays like AI, like Bitcoin, like the pot stocks, for example. But let's go over a real life setup similar to the setups and charts I recently showed you in Microsoft and NVDA, using an idea that I provided months ago, just like I did in Microsoft and NVIDIA in real time ahead of their breakout in my watch list, so that you can better understand this exact setup. So let's look at a firm as an example. So a firm, this was from my watch list. The idea came from my watch list the day before it broke out. Specifically, what was the exact setup that I was looking for here for this consolidation breakout? Well, I had identified a nice contracting consolidation. It was a bullish consolidation, and there was a nice range contraction, allowing for nice positive and skewed risk reward. Price confirmation, that came if the stock broke above resistance of this consolidation, and it held above with an increase in volume and authority. As you can see, volume also broke out on the day the stock broke out. There was a huge uptick in volume. There was elevated R-vol. The stock as well was consolidating and trending above key moving averages. So it was trending above its simple 200-day moving average, 50-day, 20-day, and it was holding above a 5-day simple moving average, which was rising. There was also a clear level of where I was wrong, where I would stop out if the stock broke above this consolidation with volume and authority, which it did. Well, that would be if it got back below the resistance of the consolidation. So all of the boxes were ticked, as I previously went over. All of the boxes for the swing opportunity had been ticked. Now that you have really a solid understanding and I would say certainly a clear foundation for this setup, from what I just went over and previously in the video, how exactly would I manage the setup across all aspects? Well, starting with how do I set my targets? Remember, I mentioned that I'm a discretionary trader and I rely heavily on technical analysis. So therefore, if a stock is breaking out and if there's a clear level of resistance ahead, those will naturally be potential targets and areas of interest. But what about when I'm trading a setup and there's no obvious levels of resistance that can act as targets? That's when I use something called an ATR. And an ATR, that's an average true range. It measures a stock's true range over a specified period. So if a stock has an ATR of 1, I can expect its range intraday to be $1 on average. If I buy a breakout and there's no clear and obvious resistance levels ahead to act as targets, my first target to lock in gains and cover risk will be a 1 or 1.5 times ATR up move. So looking for $1 to $1.5 move higher. If the R-vol, right, if the volume trading is significantly elevated after a long period of contracted volume, like we saw in the setup in A firm, my first target, I might adjust that to 2x, 2 times ATR. That's because the increase in volume might increase the attention, increase the flow, and lead to an increased range expansion. But how do I manage my risk and my position? So these factors all work together. Before I enter a position, I know where I am wrong. All right, logically speaking, where would I be wrong on the chart? So where am I wrong in the position? That's where my stop loss will go. And also, I would like to know where I think and where I believe the stock can go. So I have targets in mind, as discussed above, and either using ATRs or using levels of resistance, for example. So starting with that, all right, when I combine all of that, I need to have at least 3-to-1 R, all right, to initiate that trade, to put that trade on. My reward needs to be 3 times greater than what I'm looking to risk and lose on the trade. But oftentimes it's often it's a lot greater than that, and it's a lot more skewed. Now, how do I manage my position and risk in the setup? So I use multiple methods. Let's look at the hourly chart in AFM to understand this particular aspect better. Entry is over $27 after the stock broke above resistance, it experienced abnormal volume, and it held above the breakout zone. So right over here at entry, it breaks above resistance. All right, we have that little gap up. There's elevated R-vol, right? There's abnormal volume, and it holds above resistance. This is looking at the hourly time frame. So per the plan, the stop is therefore near $26. All right, almost one away from entry. Why? Because that's where I believe that the trade is no longer valid. That's where I'm wrong, and that's where I would not want to see the stock re-enter, all right, the range, because a failed move higher, if it reversed and went lower, comes with potentially a fast move lower after a lot of longs are potentially stuck in the trade. Now, given the enormity of the volume surge, a 1 ATR plan to 28, that was no longer really making sense. It's laid out in the plan. There was abnormal volume, so I looked to stretch that ATR on the target. So discretion can be used to exercise to stretch that 1.5 to 2 ATR given the volume. Why? Because the stock is in play. So on this opening drive in the first hour of action, the stock surged almost 10% into multiple targets. So the plan here, take off a third into a target laid out in the plan, that's into the $30 range. And then from there, it gets interesting, and it really, over here, this is really where it turns into a swing trade versus just a day trade. So how is the rest of the position managed? How will risk be managed? So I manage risk differently based on the setup and my aggression in that setup. Something to remember, though, is that if I'm trading a firm on the hourly time frame and chart, I need to manage that position and risk off of the same time frame. If you're trading a stock on a particular time frame, you need to be managing your risk and your position on that time frame as well. So due to liquidity, spread, or beta, for example, I'll manage some of my positions on a 5-minute chart or 15-minute, but here I'm looking at the hourly chart, all right? So I like to use higher lows to trail my position on the long side. On the short side, I'll use lower highs. It's just the opposite, right? So notice, once 2/3 of the position has been taken off, all right, so taking off a third here, stock makes a high low. Next day, we get a higher low here relative to the high low on day one. We make a new high, take off another third. So now we're down to around 2/3 of the position. So once the position then has some follow through, we get a high low on day 3. I can then start to trail my stop using the higher low approach, all right, for an uptrend using the hourly or the 60-minute chart. So if we had to walk through this, as you can see, you get a higher low, new stop gets appointed there. What you can do as well, and what I like to do, is I like to then manually scale out of my position as the stock makes new higher highs over the course of the following days. But as you can see, in terms of the trail approach and the higher low approach, higher low, day 4, day 3, higher low, 4, new stop gets trailed, stop gets trailed, stop gets trailed. And then on this day, we get a lower low relative to the previous day, and that would be the final exit, final stop, because the stock's made a lower low, so that trail eventually gets taken out from the previous day. So trailing my stop this way, after setting targets to lock in profits and eliminating some risk, it works well for me. I use this approach for multiple time frames and even intraday trading, but that will be on a lesser time frame, 1 to 5 minute chart. But what's key here and what's important to remember is that the time frame you're trading something on should also be the time frame that you're managing risk on. And so before I move on, are there other ways traders manage their risk and trail their stops? Another popular method similar to my approach is using the volume weighted average price anchored from the breakout day. So volume weighted average price anchored from the breakout day. And if the stock begins to consolidate below it, then one will stop out. That's how many other traders will manage their position. Another method is using the stock's 5-day EMA or SMA, and those are just some other strategies and approaches in managing your risk. Now, on to the second setup that I'm going to share with you today. This is one of my favorites. This is a mean reversion setup. This, you can call it a backside swing short, looking for a dead cat bounce. Many synonymous names for it. But, the mean reversion trade, as I mentioned, it's one of my favorite setups. And this setup, it relates also to small caps. It can relate to large caps. And it's really put into action when a stock has greatly extended from its average or its mean. All right, so from key moving averages, it's extended greatly from its multi-day VWAP in a short period of time. And once a top has been put in and the momentum shift occurs, the backside's in. For example, the stock breaks its uptrend, and or the stock begins to make consecutive lower highs. That's when I look for a pullback to the mean or to the previous breakout level, or significant level of support. That would be the target. But this is a swing short opportunity, and it can be applied in several different ways. We've already looked through large to mid caps, so let's apply this setup to a smaller cap stock, one that I've shared previously in my watch list as well, and one that I traded. So, as I mentioned before, the idea always comes from the daily chart. So let's look at the daily chart here of safety shot. And shot ran up across multiple days, as you can see, on increased volume that started to come into the stock. It ran up across multiple days in anticipation of a catalyst. That was the launch after the company made an announcement. And really, I perceived it not to be a fundamentally changing catalyst, but rather became, one can say, just a trading vehicle and a short squeeze, in my opinion. Now, this is a small cap, 34 million float. Average volume is just around 6 million shares. But on the daily chart, let's see, if this meets the criteria that we just went over for a swing short. So was the stock significantly extended in the short term? Yes, it was. You can see it significantly extended from the mean, from its previous range, as well key moving averages. It greatly extended. From multiple day VWAP, yes. From simple moving averages, yes. Did the stock put in a significant blow off top? Was it confirmed by volume? Did it experience a significant momentum shift? Yes, it did. You can see a significant blow off top followed by a tail. You can see that there was blow off volume as well in the stock. And after that, was there an obvious zone to base risk off of for potential trade? Of course there was, because we had the blow off top, which means that there was a lot of supply and overhead that existed on this day of abnormal volume and when the stock closed near the lows. There are I would say several iterations for the strategy. For example, on day one, of failure in a stock similar to this, from a technical, even from a fundamental point of view, I'll often look to short intraday, a lower high on day one for intraday or multi-day swing. I'll look to initiate it on day one. But another iteration, and I would say perhaps a better starting point for the strategy and this iteration of this concept that I think can be more easily understood and easy to identify and applied even to a broader basket of stocks. That's what we're going to go over today. So that is identifying a stock like SHOT, which is firmly on the backside, and on a higher time frame like the hourly chart, it's bouncing back into an area of major and potential supply, and therefore it's offering a potentially attractive risk reward opportunity to get short. And if you have to think about it, what creates a lower high and opportunity to get short? Sure, obviously that there could be shorts that are pushing it back up, but on a basic level, it's supply and demand. So if 77 million shares were traded on the day that the stock topped out, many longs are stuck, and suddenly a week later, right here, into this drive higher, suddenly a week later when the stock pops back up into an area where many people from day one of the stock topping out, they might not be stuck anymore. They'll likely take this opportunity to sell for a minor loss and then move on. And that creates significant overhead resistance, ultimately leading to a lower high being confirmed. So what area would one want to see the stock push back into and fail in the future after it topped out for a lower high for an entry to get short? Over here would be anywhere, I would say, from 550 up to 650. This is the supply zone. This is the overhead resistance zone because we had the intraday blow off top. We had longs trapped on this day. You know, most of the volume traded was done within this range. And again, a lot of longs were trapped. On day one, there was a solid entry short. After day one, day two, solid entry, but you know, on a higher time frame set up for backswing, multi-day swing short. As I said, various iterations of this concept and the strategy. I'm going to look for one that can more easily be applied, and that's the backside swing short entry as the chart further develops. So that's what we're going to be going over, and essentially, you know, this zone, the supply zone between 550 and 650. That's because the majority of the volume, as I said, majority of the volume was traded on the day topped out was within this range. And therefore, that's where most of the supply would be within this range of 550 to 650. So those are the key areas and levels to watch going forward. Now, how is this position entered? In theory, you would want to see the stock push back into this zone, the supply zone, and then you'd want to see it fail. That would confirm the supply demand aspect of it, and also importantly, it would give you an area to actually risk against. All right, so let's look at how this position would actually be entered and how it would be managed. All right, so now that we have that area of interest that comes through on this chart as well between 550 and 650, and we know that the characteristics, the variables of the setup are met, the focus now goes into looking for an entry and looking for price confirmation. All right, so let's look at a lower time frame, which we're doing right here, looking at a 5-minute chart, and what that entry and trade management would actually look like. So 8 days after the stock topped out on this day, it bounced back into this supply zone that was laid out between 550 and 650. All right, so it traded in a very steady uptrend, and then it broke that uptrend near the end of the day, kind of the last third portion of the day. And that confirmed the level to trade against intraday, the high of day. And now that the only thing that's needed, really, because you don't want to just chase lows, the only thing that's needed is for a pop back any lower high in order to get a good risk reward entry so that you can get short as close to the high of day as possible once it's been confirmed. So just before the close, the stock did pop back up, it popped near 580, giving an entry for short versus the high of the day for that backside swing short opportunity. High of the day is where the stop loss would go, swing entry, get a small pop into the close. That obviously lowers this range of where you have entered versus where you're wrong, providing a good positive risk reward for that trade. So I like to short lower highs, as I said, because not only does it signal that there's a momentum shift, a downtrend is beginning to form, but it gives you the best possible entry after that confirmation has been received. Because like I said, if you're shorting here on the lows, the range of where you're wrong has greatly increased versus shorting on a lower high where you get a much better risk reward. So having a precise entry is very important. I short the pub looking for a multi-day swing. That's my entry, and I'm targeting a move to the mid to low threes. So why am I targeting a move towards mid to low threes? Go back, after the stock initially topped out, that's where it found support. It found support in this area for 2 days before its little dead cat bounce, before the secondary bounce began. It found some support and it reversed right in this 3 zone. So with an entry and stop in place now, how would this actually be managed? Well, with the short entry, near 580s, a stop near the high of the day for this dead cat bounce, for the mean reversion. The risk is about 60 cents. But my target, as I mentioned, is into this 3 zone, all right, into that area of support. So I'm essentially risking 60 cents to potentially make, $2.30 a share. So that works out to be almost 4 to 1 RR, and that meets the criteria for skewed risk reward. So the position's on, and the following day, the stock further consolidates near the previous day's low before breaking down again. So, that really allowed for a solid momentum add as the price action is confirming a trend lower and it's immediately showing some downtrend potential and weak action. So therefore the stop, once you have a momentum add to the position, the stop then gets lowered to the most recent lower high. In this case, that's the day's high. And then the following day, the stock traded down into the desired target zone, and that's where the position should be covered, back into this 3 zone. Remember, not support and resistance isn't always an exact price. Sometimes it's an area, sometimes it's a zone. And the following day, the stock traded right into this target zone, allowing for targets to be met and the position to be covered. Now, the third and final play, and my third and final favorite setup, that's a setup that can be a day 2 plus, could be day 3, continuation move. It's a power play, day 2 plus continuation move. And basically, these plays, they follow the directional move from day 1 in a stock, and that could be thanks to a monster technical breakout and or fundamentally changing catalyst that resulted in momentous upside or downside, and just a severe directional move on day 1. And it has a significant directional move and closes near the high or the low of the day on day 1. So this applies as well to small caps. It can apply to large caps. Can be applied, as I mentioned, both long and short, and it works particularly well during earnings season. But something that's very important for the setup is you want to be able to identify key levels from day 1, support and resistance levels. You also want to be able to identify the previous day's high and low. And then I also like to use the volume weighted average price anchored from day 1 as a potential guide and trend indicator. So let's look at a real life example of this trade setup, one that I actually recently outlined in my free weekly watch list as well. So we have SMCI. It's a name in a hot sector, semiconductors, and it's a name that pre-announced some very impressive figures ahead of its earnings. So, I summarize what do we have here. We have a name in a hot sector. It's breaking out of a lengthy base and consolidation, and it has a massive resistance zone. On day 1, it broke out. It's hitting new highs on what can be argued as fundamentally changing news, along with a technical catalyst as well. All right, you have surging volume, and then you have a close near the day's high. So this is a prime candidate for a swing entry on day 2, using levels from day 1 for a continuation directional move higher. So as I outlined in my watch list over the weekend, ahead of that day 2 move and potential entry, I was looking for a move into levels from day 1. So I was looking for a move into 400, into 410, the support from day 1, as well as the 2-day volume weighted average price, which formed on day 2. All right, so we have 410, which is going to be level of interest from the watch list that I outlined. That was going to be the 2-day VWAP on the open of this day, and then you have 400 key support right here from day 1. So those were 2 areas of interest that I was looking for a pullback into those key levels from day 1 for a potential entry. Then, following a morning dip, likely you get some hefty profit taking. That's pretty normal and pretty logical. You can see that the stock following that dip came into this zone of interest. Particularly, it came right into the 2-day VWAP 410. It immediately found some support. Buyers stepped up after that selling, after that profit taking, and that reversal was confirmed by the support, and that was the signal for a long entry, with a stop then placed at the low of day. Because once you see this buying come in, once you see this sharp reversal after it came into an anticipated area of support, and if buying here, one wouldn't want to see the stock then reverse and take out that low. That's why, where am I wrong? Wrong below the low of day. And then after that, the stock obviously trended higher into the close, reaching my target from the original watch list and plan, came right into the 450 target. But, and this is where it gets interesting, how could this position have been held for longer, using a trailing stop to really turn it into a larger swing trade, and to capture more of the move on a higher time frame, given that the ultimate target was already reached on day 1. So this is very similar to the example that I outlined in AFRM, because as the stock makes new higher highs, all right, remember from what I outlined in AFM, how I manage the position and how I trail my stop, as the stock makes new higher highs, the position could be trimmed further and manually, locking in gains while you're trailing your stop using the day low or using higher lows on whichever respective time frame you're trading the stock on. So if you're enforcing that technique, that would have meant that the position would have been closed on day 6, which is when the stock took out the previous day's low and for the first time made a brief lower low. So in this example, another option for trading a stop could be using the anchored VWAP, as I mentioned previously, from day one, and exiting the position once stock fails to hold above it, once it remains steady below that anchored VWAP. So if we have a look here, you have your entry target was met on day 2, then on day 3 you have a higher low, day 4 higher high, higher low, so your stop is now automatically being trailed. Day 5 higher low, hasn't made a higher high, but we still have a higher low, so we're still in an uptrend. And then on day 6 we briefly take out the previous day's low. What does that mean? It means that your trading stop has been hit and the rest of the position has been closed after manually exiting as the stock makes new intraday highs following original entry on the portion that you keep as a follow-over from day 2 onto day 3. So should a call position remain after the main target has been reached, higher low, higher high, higher low method, that can be used to further trim the position, manually manage your risk, and ultimately close the position on day 6 when the stock makes a lower low. Now, I hope you all enjoyed this in-depth guide and introduction to the world of swing trading, and a walkthrough through some of my favorite setups that apply to various stocks in various market environments, both long and short. And for those that are willing to dive even deeper into this amazing world of swing trading, you can check out a recent example of a weekly video that I released previously. The link is in the comments. It shows the principles highlighted here in action, but even more, it provides some additional, more advanced commentary about that particular setup using real-life recent examples. And if you enjoyed this video, hit the like button, share your thoughts in the comments below. I'd love to hear them, and feel free to share your ways of managing your swing trading setups in the comments as well as some of your favorite swing trading strategies and even some swing trading ideas that you're preparing for right now that might be on your watch list.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of S&B Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with SMB to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part, you don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.